For me, the balance sheet is what tells me the most about a business. And ironically, it's the least used statement by most business owners because they look at the income statement because they want to see what they made. The balance sheet tells you how you're doing financially, and it's a very important piece. But what makes up a financial statement? Financial statements basically will tell you and others what's the status of your business. They're made up of three major components. You got the balance sheet, income statement, profit and loss, statement of operations, earnings statement, whatever you want to call it, and then you've got your cash flow statement. Okay, balance sheet terminology. So we've got our assets. Total assets are basically a list of all the assets, intangible, intangible, so it's going to be cash, receivables from customers, inventory, buildings and equipment, and could be receivable, long-term notes receivable if you lent somebody some money. Another big asset on there that's often is if you bought your business from somebody else, you could have some goodwill as part of the process. Because when you buy a business, you're buying two things, the assets and then the blue sky, or what we call goodwill in the accounting terminology. Goodwill or blue sky is basically the value of the business that's not tied up in physical assets. Or as I like to look at it, your ability to make more than a paycheck. So very important piece to manage as you go forward. Looking up at the board is you want to look at 2 years of balance sheets together at all times. Whenever you tie it out, you always want to look at least the last 2 years. I know when you guys look at it for loans, what do you usually like? 3, 4, 5? Okay. So the more years you look at, the more trends you can see in a financial statement. So a bit tough to read on the big screen, but you've got a copy of it in there. But you can look at like groupings. Cash, what's it doing? Is it going up? Is it going down? Is it staying flat? If it's staying flat, why is it staying flat? Why is it going up? Again, it helps you ask questions in your business to help you understand things. Accounts receivable, you would hope that it's not increasing. You hope it's not decreasing either, because that can mean less sales. But again, it just helps you ask questions to dig in deeper. If it's going up, why? Well, it's going up because my sales are drastically going up. That's fine. If it's going up because my customers aren't paying me, that's bad. Today, I'm just going to look at analyzing the business from the balance sheet side of things. So there's basically some liquidity ratios and then some capital ratios to look at. And these are things that you may not look at in a day, but you need to kind of understand what they mean. Because when you go for apply for a loan, first thing Scott's going to do is run some ratios on your balance sheet. Where's it looking? Current ratio is simply your current assets, this block, divided by your current liabilities. So how much you own or have in current assets, so basically things that are going to be turned into cash within a year, to how much do you owe or how much you're going to have to pay out within 1 year. And you want that ratio to be greater than 1. Why? Because you want to have some money to pay your debts. If it's less than 1, that means you've got less money or less assets available on hand to pay your future liability, or pay those liabilities. It's a signal that you've got a cash flow problem coming. Or it may already be here. But so again, the takeaway from this is watch your current assets and current liabilities. There should be a growing gap between the assets and the liabilities. If your assets should be growing, your current liabilities should be falling. Ultimately over time. You get it up to a strong ratio. You have a ratio of 2 or more. That means you've got plenty of money coming in. You're not going to be going home stressing about, I got a $50,000 vendor payment due at the end of the week. I hope somebody pays me. Trust me, I've been in business for 13 years. The more you get into it, the more you manage your balance sheet right, you don't go home stressing about when's somebody going to pay me so I can pay somebody else. It's a peace of mind thing in a lot of cases.